China did manage to finalize rules on yesterday, that it would scrap quotas under two major inbound investment schemes, giving qualified foreign institutions unlimited access to Chinese stocks and bonds. Now, adding to that upbeat mood, top US and Chinese trade representatives discussed their phase one trade deal on Friday, with China saying that they agreed to improve their atmosphere for its implementation, and the United States saying both sides expected obligations to indeed be met. So still a sense of positivity across the board then for that Asian market picture. 1% higher for the Hang Seng, with the Nikkei out in Japan 2.5% to the good. If we head on over to the European shares, well, the FTSE 100 not trading today. It is closed then for a holiday, but those did rise overall today as signs of improving US-China relations gave a fresh dose of optimism for investors, counting on the easing of lockdowns to spark a recovery in global growth. Now, as I said, London markets closed for that public holiday today, but top US and Chinese trade officials discussing that phase one of their trade deal, and China saying it agreed to improve the implementation, does bode well for the market. It offered some relief to investors who were worried about rising tensions between the two countries after the US criticized China's handling of the novel coronavirus outbreak. 1.1% higher for the DAX in Germany, the CAC 40 in France doing fairly better as well. Overall, let's take a look at how the picture looks. Back above 50,000 points for the JSE all share then sitting 1 2/3% to the goods at 50,851 points at present. A lot of that uptick is led by the gold mining shares, but we are seeing the likes of Assur decide that they're no longer going to trade on the JSE. They're doing it for their institutional investors who say there isn't enough liquidity in that stock. So the miner is delisting from the JSE, having been on the JSE for around 70 years. So that picture is one to certainly look out for there. On the commodity front, then you have Brent crude just hovering just below that $30 a barrel mark. Perhaps more questions around demand and how much more investors are looking for with regards to that oil price is certainly going to change things along. Gold, $1,718 a fine ounce, with the rand sitting at 18 rand and 44 cents. It's around 0.8% better off there. Just below 20 rand for the euro, and the pound sterling's at 22 rand 81 cents. Let's quickly chat to Warwick Lucas then from Galileo Capital then as we unpack this market picture. Warwick, thank you so much for the time. So some positivity then filtering through to these markets. And even in the US, the Nasdaq erasing all of its losses for 2020. Where's this positivity coming from?
Yeah, I mean, at first glance, you would think that that's absolutely bizarre. I mean, you know, if someone had said to you a year ago that the US would see something like 20 million job cuts, prospects of -5 GDP, and nevertheless markets would be in exactly the same place, you would have thought they were smoking their socks, or perhaps something stronger. So I think a big part of the equation has been the massive monetary stimulus that has been thrown in to prevent economies melting down. I think perhaps some perspective needs to be kept as to the fact that really a lot of the stimulus is in many ways backstop, and I think the longer players, one has to actually really see how this plays out.
Yeah, if you are a longer player though, I mean, where do you find value in a time like this? Do you just hold on for dear life almost, or do you perhaps say to yourself, you know, there are a few bargains at this point in time, and look to fundamentals and what really works for a longer term share price?
I think there are bargains out there. I think one definitely doesn't want to be embracing risk for the sake of embracing risk, however. And certainly in the case of South Africa, I mean, we have some bargains in the form of our bond market, for example, which is offering an 8% real yield, which is really an equity-like yield at the moment.
That bond market
so we have options.
Sorry, Warwick, but that market seems to have done some weird stuff as well, though, at present. And that includes just being resilient, despite the fact that we got downgraded to non-investment grade and officially exited the WIGBY. So clearly then, market fully pricing in that fall?
Very much so. I mean, this is one of the most long anticipated downgrades, I think, just about ever. So I think we might have had a certain degree of either underweighting or certainly some hedging on that for some time. And it is quite a typical pattern that when you get these downgrades, the event itself generally creates a spike even before it's actually physically implemented. And I think we see that that's exactly what has happened in our case, that there were so many speculative positions on this issue, and then when the reality hit, it was already expected. So I think we're in a pretty comfortable position that we have a kind of a new normal in our bond market. Yeah, as I pointed out, I mean, if you're offering 11% and inflation is around about 3 to 3.5%, possibly anticipated inflation may even be lower in the short term. That's 8 real. That's a excellent yield, even if short-term economic prospects look ropey, to be putting it mildly.
Some would say short to medium-term prospects, really, that certainly look a little bit worse for wear. Let's talk some equity news now. A sore delisting from the JSE, perhaps not too much to write home about, but what does that say with the SAW leaving the JSE? Then you have AngloGold Ashanti, of course, leaving South African shores as well. What does that really say for South Africa's mining industry as a whole? And then at the same time, not necessarily the same thing, but SAPI also then cutting capex. How difficult is the situation faring then for equity stocks?
Look, I think when it comes to fundraising, particularly for commodity businesses and large commodity businesses, I think they're going to always try and play in as big a capital raising pool as they can. And particularly large businesses which are dominant in their sectors, such as AngloGold, SAPI, and Assor for that matter. Although in the case of Assor, I mean, they're not short of capital, and in any case, 80% of shareholders are staying on board. So it's really the remaining 20% that are coming off the board and taking the delisting payment. And I'm sure, given the fall in markets, none of those shareholders are fighting off taking the payment at the moment. So I guess even though it was announced before COVID was featuring in anyone's calculations, I guess that is why the company is persisting, because it's such a tight shareholding grouping, and why minorities are only too happy to go along with it.
All right. Very quickly then, on the local banks, they're saying they're not going to retrench staff, especially because of the coronavirus at present. Certainly good news, but does it perhaps delay the inevitable, unfortunately?
I think with the banks, they've generally been quite good about maintaining very lean levels. So, for example, through 2017, 2018 and 19, we saw in most of the banks that they typically had in one or two cases some retrenchment programs, but also quite a lot of reduction through attrition. So they've actually been running quite lean for quite some time, and that's meant that they were in a position going into the whole COVID crisis that they were already correctly staffed. And as it is, I mean, right now with government providing backstops on loans, the banks are actually in a position where, even though bad debts are likely to go up, they're also in a position to be able to extend credit. And as such, I don't see an immediate need for the banks to cut staff. So I guess it's good that there's at least one industry that's not going to chop headcount in this environment.
Yeah, we certainly appreciate it as much as possible. But we also appreciate your time, Warwick. Thank you so much for joining us this Friday as well. Have an absolutely great Friday and a good weekend. Warwick Lucas then is from Galileo Capital, helping us unpack that market movement. Look, that closes off things from my point of view when it comes to On Point. The market factors are clear, and it certainly is hurting things along. But my colleague Diabo Seto does join you very up next then, right after the short break, with SME On Point as well as Your Money. My colleague Nastasia Arendse will also then join you as well a bit later on for Books On Point. From me, though, that's where the buck stops. Have a great afternoon and enjoy your weekend.